Risk and control self-assessment is not a mere checkbox exercise. It's a proactive approach to identify potential process failures before they impact audits, regulators, or customers. Welcome to this video. I will explain you RCSA in 5 minutes, from process to risks to controls. It helps you understand where your operations might falter, allowing for timely intervention and strengthening of your business resilience. Remember, RCSA is fundamentally owned by the business, not solely by risk or audit departments. Step 1 is to define the process with granularity, because a vague process leads to a useless RCSA. Consider a banking example, the loan disbursement process, which involves several distinct steps. These steps include loan approval, customer KYC verification, disbursement amount validation, funds release, and confirmation sent to the customer. Crucially, one RCSA should always equate to one specific process, avoiding enterprise-wide generalizations at this stage. Step 2 involves identifying risks by asking, what can go wrong? A simple and memorable formula for risk is event plus impact. In banking, for KYC verification, a risk could be incomplete or fraudulent KYC, leading to regulatory penalties. For disbursement, incorrect amounts released could cause financial loss. And for confirmation, customers not being notified could lead to disputes. In SaaS operations, for customer billing, inaccurate usage data can lead to underbilling. Incorrect pricing rules applied during invoice generation or invoices not sent on time can delay cash flow. It's vital to avoid generic risks like operational risk. Instead, risks must be observable and testable. Step 3 focuses on identifying controls. What prevents or detects problems? Controls can be categorized as preventive versus detective and manual versus automated. For fraudulent KYC, a system-based mandatory document validation acts as a preventive and automated control. For wrong amounts disbursed, dual approval for amounts over a certain threshold is a preventive and manual control. Missing confirmation can be addressed by an auto SMS or email triggered by the core banking system, which is a detective and automated control. In SaaS, inaccurate usage is controlled by an automated usage reconciliation job, a detective and automated control. Wrong pricing is prevented by pricing rules locked in the billing engine, a preventive and automated control. Delayed invoices are detected by scheduled billing runs with failure alerts, a detective and automated control. If you cannot explain a control in one clear sentence, it's likely not clear enough. Step 4 is to assess inherent versus residual risk, keeping it simple without complex scoring. We use simple scales for impact and likelihood, low, medium, or high. For fraudulent KYC, with strong controls, a high inherent risk becomes a medium residual risk. For wrong disbursement, moderate controls reduce a high inherent risk to a medium residual risk. Missing confirmation, with strong controls, reduces a medium inherent risk to a low residual risk. Remember, residual risk is what management accepts, and high residual risk always requires action. Step 5 focuses on action plans, which is where the true value of RCSA lies. For banking, action plans could include automating KYC validation for non-standard documents. Another action could be reducing the dual approval threshold using risk-based logic. For SaaS, action plans might involve adding a pre-billing validation report or implementing an invoice preview for enterprise clients. Without action plans, your RCSA has failed. Owners and dates are mandatory for every action. To immediately apply this, start by mapping just one process. Conduct one RCSA per session and update it quarterly or after any major changes. If you can map your process, write clear risks, and explain your controls, you've done a real RCSA. No templates or consultants required. If you like this video, hit like button and subscribe to this channel to get more videos like this.